Hey folks, it's Mortgage Mike here with the Mortgage Mike Group in the heart of real estate. And I just wanted to share with you some ideas on the 2-1 buy down, because we get a lot of questions around what is a 2-1 buy down, how does it work? And I'm here to demystify it for you. So I want to share my screen and just show you how things come together when we look at a 2-1 buy down. This is a great piece of software that Stephen and I use to help our clients understand financing options. And so what I want to show you is that we've given you a couple of options here. One is the $500,000 to 20% down, a $25,000 reduction to the sales price, because a lot of times 2-1 buy downs are floated in lieu or price reduction. We've got a 2-1 buy down in year 1 and a 2-1 buy down in year 2. I took a $500,000 purchase price. Notice the difference in interest rates, actually right here. The first two options are at 7%, which is what the note rate would be. And honestly, the note rate would be the same thing on a 2-1 buy down. However, what happens in the first year is that the rate starts at 5, and then in the second year it goes to 6, and then in the third year it's at 7. So the note rate's set at 7%, not at 5 or 6%. What we begin to see is like, what is the cost savings on the payment? And so we see here that the monthly payment savings at a 5% interest rate is at $513.92, and at the 6% interest rate, the monthly payment savings is $263.01 over what would start at $2661.21 for a 7% interest rate. Notice here that the $25,000 price reduction does save the client $133.06 a month. Now, where does the cost of this 2-1 buy down come from? What happens is that we take this $513.92 and we divide and multiply that by 12. We take this $263.01 and we multiply that by 12, and we add these two numbers together, and that gives us the contribution from the seller right here of $9,300. So the cost of the 2-1 buy down is $9,300, or $9,323.16. That's a contribution from the seller that prepays that interest over the first 2 years. So if for some reason, let's say rates drop and it makes sense to refinance, our buyer clients can actually use what's not used, any unused portion of that prepaid interest. They can actually use that to help offset closing costs on the next mortgage that they make out there. So the bigger question is like, does it make sense to deploy a 2-1 buy down? I certainly think so, in probably some limited circumstances. We got to have a client that's bringing plenty of money to closing. I do think that if we're looking at a situation where we're at 5 or 10% down, a $9,300 contribution to buy down the interest rate may not be the best thing for our client, because we might want to really just put that $9,300 towards offsetting closing costs and prepaid items. So it's really a cash to close issue for the buyer client more than anything. And what do they want to do and how they want to deploy that cash, I think, is less of a payment related issue in most circumstances. So anyway, those are my many thoughts on the 2-1 buy down. If you got any questions or comments, man, shoot them below. We'll respond to it and we'll give you our feedback on that. Thank you so much for watching.